week on Sylvia's Traders Lounge.
Citigroup underperformed the market in the last 10 years by 209%. Alcoa underperformed by 252%. IBM by 254%. Exxon, world leader, they underperformed SPY by 258%. Ford by 267% underperformance, and GE by 275%. So these are the stats we need to take a look at. And let me ask you this question. So when's the last time you heard the mainstream media talk about these negative 10-year results with these giant corporations?
Rarely.
Yeah, exactly. It's what we call AWOL. We don't hear about it. So that's why it's so important for investors and traders, depending on what their strategy is, to know the best investment vehicles out there, because they aren't getting it in the mainstream media.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is David England. Our theme is The Future is Now, Stocks and Funds for the New Normal with David England. David England has been blessed to have two successful careers, one in academia as an associate professor of finance, the second as a successful trader and investor and developer of proven trading and investing systems. In academia, David developed college-level investing and trading, one intro and one advanced, unique to higher education in the United States. His classes began with This is a Stock and progressed through trading E-mini futures. David developed successful systems to give students what he calls HPTs, higher probability profitability trades. His trading system is the Simple Simon and Garden Growing in his investing system. In 2015, David received national attention when he challenged CNBC's primary stock picker, Jim Cramer, to a gentleman's challenge. David gave free online lessons on how to use his Simple Simon system. In November 2017, David sold the rights to his investing systems. After a 2-year sabbatical, in January 2020, he started a new stock market educational business, Eye on the Markets Analytics and Training, featuring a weekly column along with podcast where David shares his unique view of the market and trading stroke investing opportunities. New in March 2021, David rolls out his new groups of leading stocks and funds for the new normal branded The Future is Now group. This group focuses on key sectors leading investors and traders into the new paradigm he classifies as the Industrial Revolution 4.0. In quarter 4 of 2021, his exceedingly popular classes will be available online in an English version. Known for his humor and common sense approach, he brings a refreshing blend of academia and successful investing stroke trading experiences to his seminars, classes, columns, and podcasts. Welcome, David. It's nice to have you again on the lounge.
Well, thank you very much for having me, and welcome to the people in the United States. Good morning, and also good afternoon to my friends in Kenya.
Yeah, and you can start off by telling us, as you're still a professor and an active investor, what does the initiative The Future is Now do for people looking to invest in stocks and funds?
Well, it gives them more choices, and it gets away from what I call the old world companies. Companies have not kept up with the times and technologies and have grossly underperformed the S&P 500 for the last 10 years. And unfortunately, many people still have their retirement dollars in these companies that hopefully they won't turn into dying companies, but they definitely aren't growing. And let me give you an example of this. In the last 10 years, and I'm a very pragmatic person, okay? And if I make a statement, I'll be able to back it up, or I shouldn't make the statement. In the last 10 years, the total price return, that's the price and dividends of the S&P 500, is 204%. Well, we can't just invest right in the S&P, so we invest in either a mutual fund that covers the S&P or an exchange-traded fund. So I like to use the exchange-traded fund, SPY. During this time period, because it pays a higher dividend, the SPY's return was 271%. So let's keep that in mind. So I'll name just a few of these, what I call old world companies: Citigroup, Alcoa, IBM, Exxon, Ford, and GE. Now, these are good companies. I can remember back in my college days and back in the 80s, it was a goal for some to work for Big Blue, which is what is called IBM. It was an honor to work for these large companies. But let's just see how investing in them in the last 10 years have been. And so what I look at is I take the total return of these companies and see if they've outperformed investing in just the market, SPY, or underperformed. So I have some stats. And by the way, my business is also analytics. I'm a stats guy, and that's what I look at. Citigroup underperformed the market in the last 10 years by 209%. Alcoa underperformed by 252%. IBM by 254%. Exxon, world leader, they underperformed SPY by 258%. Ford by 267% underperformance, and GE by 275%. So these are the stats we need to take a look at. And let me ask you this question. So when's the last time you heard the mainstream media talk about these negative 10-year results with these giant corporations?
Rarely.
Yeah, exactly. It's what we call AWOL. We don't hear about it. So that's why it's so important for investors and traders, depending on what their strategy is, to know the best investment vehicles out there, because they aren't getting it in the mainstream media. And that's why it's such an important thing on what you're doing with scope markets and what I do in the United States. Put the facts on the table and let the investors decide and the traders decide depending on their strategy.
All right. And then you mentioned a couple of companies. So how do you evaluate, how do you identify which companies are good to trade in, to invest in?
Well, the first thing that we need to do is to define our strategy. Now, the investment community is obsessed with the strategy of buy low, sell high, so that we make our money with price appreciation. See, I've been in this since 1987. There's other ways that you make money other than price appreciation. So before we get into what I look at, we need to first define our strategy. The other one is what I call my garden growing strategy. And in a couple of months, I'm going to be talking more about that. But it's where we focus on dividend paying, either securities or funds. I prefer the high dividend paying funds. There's less homework in studying those than there are individual stocks. And I have a list of those that pay monthly dividends. And so have that monthly dividend go back into revenue, into building share growth. So that strategy is in 10 to 20 years, let's see how many times we can double or triple our amount of shares. And then when you get into retirement, case in point, you start out with 100 shares of a high paying fund. Maybe within 7 years, those are 200 shares. By the time that you need those for retirement, you may have 400 shares with an original investment of 100. And then at that point in time, then just have the dividends paid to you instead of, so Wall Street's paying for your retirement with that strategy. And maybe we can talk about that at another time, but we don't know our strategy until we decide where we want to be, right? So we decide where we're going to be. From there, back to your original question, one of the first thing I look at is volume. I learned years ago, follow the money. Institutions spend millions and millions on research trying to figure out the future leaders. So learn to follow the money. The trail is with the volume. In case in point, if we're going in the woods, and I'm an outdoors person, and I've seen some of your pictures of going out and with the animals there in Kenya, and I love those. I wish you'd send more of those, especially with the wildlife, and it's beautiful. It's one of the things that I like the most. But if I'm out in the woods, I'm going to go through a small trail or a big trail. Well, the big trail is where the elephants go through the woods, and that's with a higher volume. So I want to make sure that I want to be where the big money is, the institutions. The second thing is we've got to determine future demand. Now, that's the tricky part, because not only do we want future demand, we want future demand that's going to be profitable. And I'll give you an example. One of the groups in The Future Is Now group is the cannabis industry. That's the company that's cannabis or cannabis related. And I like many of the cannabis related just as much, because we have a challenge in the United States and it's that federally cannabis is illegal. But to raise revenues, many states have jumped on the bandwagon. And it's odd that for years people go to prison for this, but now all of a sudden, because cannabis is bad, and I'm not going to be talking on the good or bad part of it, I'm definitely for medicinal cannabis, definitely for. The recreational, that's somebody else's, that's an adult's decision. So states to find revenue all of a sudden saw things that used to be illegal. Now it's ethically okay, so they make money on it. I think you're probably going to be finding out the same thing in Kenya on that situation, but that's for another day to discuss that. But we had many people jump on the cannabis bandwagon because some states made it legal, but they were buying cannabis stocks, and to come find out, many of them really lost. In the United States, we have the saying, we lost their shirt. I don't know if that's a saying in Kenya, but that means they lost money. And so just because there's going to be demand doesn't mean it's profitable. And one of the reasons there's so much challenge on the profitability of cannabis companies is because that for every dollar spent, so much of it goes to state and local municipalities and not to the companies. So that's a challenging aspect. So number one, look for the volume. I don't like to trade anything that doesn't have at least 100,000 shares a day, average volume, because you may have a day that's a half market day, like the day after Thanksgiving, or some of these other, if it's a half market day, you might as well call it quits. That volume technically skews the results. So look for volume and look for future profitability of those companies. And you do a lot less homework if you focus on the funds. Okay?
All right. And then looking back to 2020, do you find it ironical that the top 20 performing stocks in 2020 zero up from the Dow Jones?
No, I don't find that. The Dow Jones is so outdated. And by the way, when we talk about the Dow Jones, there's 65 stocks in the Dow, but it's in three different groups: utilities, I believe transports, and the industrials. So at one point in time, the Dow was a very, very important mechanism that we had for research. And then, of course, at that point in time, the Dow owned the Wall Street Journal, the number one publication. Now, believe it or not, I still get the Wall Street Journal. I get it delivered because I read it online also. It's a very, very integral part of my strategy in doing my research. With that being said, the Dow Industrials, how can 30 stocks dictate the true strength of our market? And by the way, it's called the industrials. What it needs to be is the leaders in different groups, because some of those are not what we call the smokestack industries, which a lot of people look at. And they equate that with industrials. But in my 20 performing top stocks, between 0 were in the Dow, only 2 were in the S&P, and only 4 was in the NASDAQ 100. And one thing I must clarify, anytime you see any stats, any statistics, we must always challenge how authentic they are. And when we see stats and reports, when I see a survey, the first thing I look at is who's the underwriter? Who paid for this? Case in point, if I'm driving down the road and I hear a study that says if you eat a T-bone steak a day, that's going to help you with a healthy heart, okay, but it's sponsored by the Texas Beef Council, I'm going to be kind of leery of that. All right, now I like a good T-bone. Porterhouse is my favorite, but that's only about once every 3 months. So always take a look at any data. I'm going to qualify this data in saying that how I determined those. First of all, the stock had to be over $12 a share. So that eliminates a lot of companies. The second, it also had to have an average volume of over 100,000 shares a day. So that put it into an elite group. And yes, whenever I ran those totals and saw that only 4 were in the NASDAQ 100, 2 was in the S&P 500, and 0 in the Dow, that told me that if somebody just invests in those indexes, which I think it's wise to take a look at, instead of chasing individual stocks, that the indexes that we follow do not represent the new normal, stocks in the new normal, what I call the Industrial Revolution 4.0. So it's kind of like if we take a look at from a military standpoint in the Navy, we have these large aircraft carriers, and we have what's called a little destroyer, small ship. And so these overall companies and these indexes are like a large ship, a destroyer. Excuse me, aircraft carrier. They're large. It takes a long time to get them to move or make any changes. Versus a destroyer, they're quick. They can get in and out. They're fast and nimble. I want to be investing in the things that's going to have the best financial return to build financial wealth for me and my family. So, yes, we aren't going to discount the indexes. They're scrambling to make sure that they have what are the up and coming stocks. But it takes so much. And by the way, the indexes, who decides those, is very, very political, Wall Street wise in our country. So we need to always break down where's the data come from, how's it put together, and always take a look at the indexes and what's in it and see if they are keeping up. And that's why it's so important to take a look at some of us that are actually telling the truth about this, because a lot of those things you won't find about in the mainstream media. Why? Well, I'll explain to you this way. Are you familiar with what Hollywood is in the United States, Sylvia?
Yes, of course. We consume a lot of content from Hollywood.
Well, I call the main stocks in the indexes, those are Hollywood stocks. Those are the ones that get the most people's attention. Those are also, and we can connect the dots here, those are also some of the largest advertisers in the world. So the largest advertisers are always going to get more attention. As we're going to see when I roll out this group, a lot of these companies you never heard of, because they make something that goes into something else to make this other thing either more inexpensive or quicker. And so like years ago, there was a company called Akamai Technologies, AKAM. We wouldn't be here today if it were not for Akamai Technology. Why? Because they were the industry leaders in streaming, and their symbol was AKAM. I just want to make sure we get that. And that's not a buy recommendation. But who had ever heard of Akamai? And is Akamai in the Dow? No. S&P 500? Don't think so. NASDAQ 100? I have to look at that. But it's these things, these companies we never heard of that makes what we do easier. And if you would have told me 10 years ago that in February 2021, I would be able to sit in one of my offices and talk to associates around the world in Kenya live. Now, there's a fraction of a second different, but it's pretty live on HD TV. I would have said, you're out of your mind. But that's how fast technology is moving. And matter of fact, we'll be using technology in the next 3 to 4 years that Sylvia has not yet invented. And so that's the exciting part of being what we're doing in 2021.
Yeah, and Samson here has a question.
Yes.
Yeah, so this week, we've had an interesting week. And for the first time, we've seen the Dow outperform the S&P and NASDAQ. I think it was on Wednesday. And maybe I'm wondering, okay, the thinking is a lot of these value stocks are starting to catch up with growth stocks. So what's your take on that? And what do you think the outlook is for the rest of the year?
At one point in time, many of the large three indexes, the Dow Industrials, the S&P, and the NASDAQ were in lockstep. And that's no longer the case. Why? Because they have different components compared to what they used to have. They used to have a lot of them that were compatible. So it doesn't surprise me to see the Dow up one day, down the next, the S&P. So they aren't in the correlation, sir, that they used to. And a large part of this huge rally that we've had is due to the trillions that's been put into the market globally, plus low interest rates. The money put into the market, low interest rates, that's fuel to the fire. So we've had this huge emphasis on growth. Now we're taking a look at some of these stocks, we're taking a look at value. What's best? There's no one that's best. It depends on where we are at a particular time, and it depends on what your strategy is. And also, are you a trader? And are you a swing trader or a day trader or a 2 or 3 day trader? So every type of objective has a different strategy. And what's going to happen with this pullback, since we've had such a huge run, it's not a question on, are we in a bubble? Are we not in a bubble? People can talk about that all day long. That's not the question. The question is where are you going to have your stops in case we have, especially if you're in retirement or close to retirement. But where are you going to have your stops for those days that we wake up and the market's down 3 or 4%, like we saw some last year? So the question is not if we're in a bubble or not. It's how are we positioning our portfolios for when that happens? If we're in high dividend paying securities and we have a huge pullback, we're smiling because that buys us more shares. If we're trading, I always have a hedge on and I'm shorting some part of the market so that not everything just goes up or goes down. We're going to have profit taking. Has it started? Yes, some of it already has. Matter of fact, since the top, and some people are saying that was on February the 16th, I go back and look at the close on the 12th because we had the holiday in there, adding a few days. I think the top's already in. Now, whenever we go in and we've tried to match that previous top and we've been unsuccessful, that's a huge sign. But we have a correction ahead of us, depending on where we are on the market. And I don't have the market on right now. I did earlier, but whenever I have the opportunity to visit and to do one of these interviews, I don't have it on so I can focus. So I have no idea what it's doing. But I'm going to guess sometime today it's going to sell off. And when the NASDAQ goes down further, it'll be in correction territory. So what's going to happen is those people that are already up, and they're up 40, 50, 60%, 70%. And I get these emails every day. What do? Well, I don't tell people what to do. I teach them what to do with their money so they make their own decisions. But they're going to be hitting that sell button to lock in those profits. So one of the things that's going to be, and by the way, that's a very excellent question, young man. We're going to have increased volatility. No doubt about that. We're going to have a good clock cleaning pullback ahead of us. When to start? I don't know. I don't worry about those things. But so what we do is we look at, when we talk about value, some of these growth is going to get down 20 to 30% because the ones that will get hit the most are the ones that have had these phenomenal runs and the hundreds of percents of returns since March 24th of 2020. And many of those are in my group. So it gets down into a buy point. I see most people fear corrections. I love corrections. Why? Because those securities are the ones that pull back the most. And then when they get into my simple Simon buy signal, those are the ones that I can start adding inventory on, and that shares on a daily basis. So we have a correction ahead of us. Just be prepared. How's that going to affect your current holdings? Are you hedged? Do you have any volatility or something that goes puts or so forth? Or do you go long the inverse funds that go up when the market goes down? Or how are you positioned? Or are you sitting in cash waiting for a good pullback to be able to buy stuff after a 20 to 30% drop with some securities, or a 10 to 15% drop on the indexes? So I would be surprised if the market closes up by the United States market closes up on this end of the day Friday. But I don't trade what I think. I only trade what I see. And so I see increased volatility and a ton of opportunities as these high flyers, these good companies, the futuristic companies, come down into a buy zone. So I hope that answers your question.
All right. And then from your perspective, David, what would you say in regards to investors and traders continuing to invest in what is termed as old world stocks, unaware of the vast paradigm shifts ongoing currently?
I just say be very, very careful of those. Go in before you ever take a look at a security. Go in and take a look at the 1 year performance. That's a relative performance. And a lot of times your brokerage houses won't have that. Relative, that's price appreciation or depreciation and dividend reinvestment. So always take a look at a security. What's the 1 year total return, 5 year and 10 year? And there will be many, many so-called industry experts beating the drum on these companies, saying they're value stocks. Price can't get any lower. Well, just go in and buy it, and you probably see the price can get lower. So just be very, very careful of what I call these old world companies. Be open-minded. Take a look at these new companies, as that's where a lot of the opportunities are. Now, what's going to happen is some of these new world companies will be buying up the assets of these old world companies. This is called business. This is the endless cycle. Go in and take a look. Now, so as a professor, here's the assignment here. Go in and take a look at the leading stocks in 1980, 1990, see where they are now. Half of those names you won't recognize. Why? Because the new companies have merged or bought out the assets of the old companies. And so just be careful of these old world companies and be receptive to see and when you see the returns on some of these, and by the way, we don't chase returns, but this is where the institutions are putting their money. And after a pullback, it's going to make these lists very, very advantageous to study and invest in.
All right. And the COVID-19 pandemic, let's go back to last year.
Yes.
It forced over 10 years of technology into the market in less than 1 year. So that led to considerable opportunities for traders and investors. What events caused that to happen from your view?
Well, from a business standpoint, and by the way, the COVID was a terrible thing. We've all know people, we've lost loved ones, we've lost friends from that. It's a tragedy. That's what happens after pandemics. What I'm going to address is the business side of it. So yes, whenever the COVID, the pandemic, it put business and civilizations on their knees, so to speak. Couldn't get out and do the business and the shopping that we needed to do, whether it's safe or not. And it wasn't safe. So what happened is 10 years of future technology was introduced to us in the second quarter of 2020 through Zoom. We're using Zoom today. Then, of course, the success of Zoom opens the door for many other technologies and any other companies. So that's what put all this technology into 10 years into today. But the exciting thing is we wouldn't have known about many of these companies if it were not for COVID. And because I wish we wouldn't have had COVID, that's for sure, because I lost loved ones also. So, but we have a different paradigm in business. After COVID, are we going to get back to normal? Absolutely not. We have what's called the new normal. Some people will be working more from home. When corporations can save an average of, now this is an average, depending on where the corporation is, an average of $20,000 per employee, they're going to be forced, since the competition is so brutal, they're going to be forced to save as much money as they can. So we have a different way of life. Matter of fact, with these Zoom conferences being so important, I'm building a second virtual studio in my home so to have different backdrops, because when I don't want to be doing these types of presentations in the same studio or the same office as my trading room. And that causes an opportunity to buy new products, put more money in the market. Case in point, whether it's the new 27-inch iMac I'm talking with today with the retina situation, which I still haven't figured out, but it's pretty good stuff. I like the results on it. We have a new paradigm brought about after or during the pandemic. The exciting thing is what's going to be the new normal 2.0 or 3.0. Well, I have a feeling we're going to be right on top of that and hopefully be able to tell our followers about that.
Yeah, and I think you can take this time to talk more about your Future is Now group. I know you focus on artificial intelligence, cloud computing, cannabis, fintech, healthcare, digital medicine, cryptocurrencies, among others. So you can take it away.
Okay, there's 15 groups that I follow. You named several of those. And there's some exciting sectors in here. One of them I don't think you mentioned, the space race. I can remember back in 1963, I think I was 5, I barely remember this, when we had the race into space. And with that brought about many new products. Teflon. We have a company here in the product in the United States called WD-40. And I'm sure they have that in Kenya, but WD-40 was the fourth equation to help water disbursement, WD, off rockets, because the water with rockets going through the atmosphere, it made many of them explode. Well, that was a product that came about from the space race that then transferred to a consumer product. That's the same thing we have now, this space race. It is so exciting, crew, to be able to sit here and watch transmission from Mars. So exciting. And we also have this from different companies and different countries that have been to the moon and used satellites from the moon. And so we're in an exciting time. So I take a look at these 15 different sectors Space race is one of them. Fintech, the way that banking has been turned upside down. Let me give you an example. In the banking sector, the top 10 companies by market cap, 2 of those aren't even banks. They have banking functions. The first one is JP Morgan. The second one is a company called PayPal. And because of the Venmo, that's what a lot of people will recognize that with. In that top 10, we've got a company called Square. If we go to countries and we go to their markets and buy, we no longer have to have go and get to their currency. The vendors in a lot of the third world countries have Square on their iPhones, and all they do is they run our card against that, and it processes. And with the artificial intelligence, as we don't fear artificial intelligence, we learn more about it because it has tremendous opportunities, job-wise and technology-wise. But so in the banking industry, due to the transaction costs going down, it's turned banking upside down. You're going to see more and more banks closing what we call the branch offices in small communities. Now, I know you guys live in a place that has several million, correct? Okay.
Correct.
We have 5,000. Now, in our area, we have over 300,000. So the way that we do business in our small area is completely turned upside down to what it was a year ago and 2 years ago. But that leads us to opportunities. We're going to see, case in point, the Super Bowl, the worldwide event. Who was one of the largest sponsors? Rocket Mortgage. Many, many people are now taking a look at buying real estate online, doing more things online, getting their mortgage online. And so that's one of the many, many things that, as far as the technology, the crypto, the blockchain, one of the sectors, next gen, online gambling in esports. Once again, what used to be illegal, now more states to get revenue make online gambling, which is a very dangerous concept, make it legal. Renewable energies, smart grid. Here's one of my favorite: electric vehicles, autonomous vehicles, and the lithium batteries. So what I do is I monitor these 15 areas. And what I'm going to be making available, and I want to have this a price of only $100 so that it's very economical. For 8 weeks, you get the 7 top the 7 top groups, and each week I'll send out 2 messages, 2 emails. One, I focus on the top funds in that group. Second, I take the top funds and focus on the top companies. So that by the time the 8 weeks is over, then you're going to be introduced to the top 7 funds and the top companies in those funds, so that you can be better educated to see what's going on in this new world, this Industrial Revolution 4.0. And I'm really excited about that. And there'll be more information on that available at my website, Eye on the Market Analytics. If you listen to this or watch this on Facebook, just click the link. But due to the fact that I'm keeping the price low, whenever you take a look at a white paper, this kind of data, many times this is sold for $300 and $500. I'm just putting $100 on it to introduce people to the many, many opportunities that are out there. Sylvia.
All right. You have questions?
Oh, yeah, of course. Based on some of the things that you're currently looking at, what would be the best ETFs for an investor to check out? For example, things to do with AI, artificial intelligence, for investors.
Well, let me pull my list up here. And we take a look at the artificial intelligence, the robotics, AI. Let me just give you a couple of these. iShares Robotics is one that I really like. IRBO, ROBT, the First Trust, NASDAQ, Artificial Intelligence. And then, of course, the ARC Group. Kathy Wood was my 2020 Financial Entrepreneur of the Year. ARKQ, Autonomous Technology and Robotics, would be one of those. So I follow 9 or 10 there's three to give you kind of an idea about some to take a look at. You know, when we take a look at the results on these, we take a look at the time period from, excuse me one second, timer just went off. When we take a look at the time period from March 24th to February the 12th, the S&P 500 SPY was up 70%. Some of these, the returns in this group are phenomenal. I had one, the leader was 580%. Many were up 300%. Many were up 200%. Now, would I recommend just go in and buy those now? Absolutely not. We don't chase things. Anytime we chase things, we get into trouble. But what I'm looking at is to start monitoring these very much in demand sectors and funds. And then when we take a look at the pullback, which is coming, may have already started. I'm sure probably some of it already has. Then when it gets down into what we see as a value, use that simple Simon strategy I have to enter into these. And also when you enter into them, don't just enter into them all at once. Dollar cost average into them so that you spread out your risk. So those are just some of the, a couple of the ETFs that are on one of the groups that I watch, especially that AI.
Prof, what do you basically find interesting about crypto? Is it the coin itself, the digital coin, or is it the blockchain technology? And what will you advise an investor to really look at? Should an investor just be focusing on the price and all the excitement that is going on? At this point, I might call it mania, but I don't want to really. What would an investor, a long-term investor, really look into before getting into any coin or investing in any coin?
First off, if you're a long-term investor, you would only want to take a look at a small part of your portfolio into that crypto space. And then I'll get back to the very first part of one of those questions. When we take a look at the crypto space, we analyze the coin part, the digital coin part, or we take a look at the blockchain part. I'm more excited about the blockchain part, that I can trade with an exchange traded fund or a company in the blockchain, than I am the cryptocurrency. Now I'm excited about the cryptocurrency. Am I going to chase it over $40,000? Absolutely not. $40,000? Absolutely not. But when we have a good pullback, which is ahead of us, it's just inevitable, then I will be moving some funds into the cryptocurrency as far as the digital, actual cryptocurrency. And I will also be moving funds into the blockchain technology with some of the blockchain funds. Will I have more than 5% in it? Probably not. And just like the last 2 weeks, I had somebody contact me and says they've got some what they call fund money, 20 to 30,000. Why shouldn't they just jump right into the blockchain right now? And I said, well, first of all, don't invest in something you don't understand. And by the way, I don't know anybody out there that really 100% understands price movements that goes from 3 to 4,000 to 10 to 20 to 30, back and forth, up 40, and where it's going to go from here. That's where, since we can't stay this much, that's almost just pure gambling because of what's really moving it. But one of the things that shows me that we're going to have even higher prices for many of the Bitcoin types and the mining is due to the aspect of more and more institutions are going to be coming on board. And if they don't show that in their stock price, in their funds, people are going to say, why not? So as more institutions come aboard, you're going to see higher prices with the Bitcoin type, the cryptocurrency. So I'm very, very excited about that. I'm not excited about people just going all in, and then all of a sudden that $20,000 to $30,000 is now 10 to 12 or less. So we must be smart about getting into the crypto space. Another reason for the demand of crypto is that, and I'm going to be writing about this in the next couple of weeks, gold and silver is no longer the risk trade. Just take a look at the charts to see that. The risk trade, a large part of it has gone into Bitcoin. And the same with inflation. with the yields coming up. We've got some really, really tough challenges ahead of us today, tomorrow, and the next week about these high-flying equity prices. So caveat emptor, buyer beware about entering in at these large levels. Let it pull back into our buy zone before investing hard-earned money. And the last part about that crypto is the aspect of we've had such a large run. Many, and up to part of this large run, are corporations buying back their stock. Well, since their price is trading at a premium, many corporations are not buying back their stock. Where are they putting that money? They're putting it into the crypto space. So that's another catalyst for higher cryptocurrency prices ahead. And then before I even go into any strategy on that, which we don't have time today, but make sure in your digital wallet, don't lose that password. Because you lose that password, it's not like losing the password to your phone account or to your bank account, or say, please send me something, I want to change my password. There's been people that have found out by losing millions of dollars, the danger of losing that digital password. Also, never trade something you don't understand. Go in and do your homework on crypto. Then go in and do more homework. But don't be afraid of it. But be very careful about how much you allocate out of your portfolio into this exciting group. So I hope that answers your question.
Definitely.
All right, and I have a question on AI and the rise of algorithmic trading when you're looking to invest in funds. So what pointers should people look out for given the rise in quantitative funds and where the technology is taking in finance? What would you tell people to be observant about?
If it's too good to be true, it probably is. The world is moved now by the algo trading. Many things in our life are dealt with algorithms, whether it's in medicine, whether it's in business, whether it's in technology. So one of the things that I take a look at before I look at any fund, find out, number one, what's in that fund. Now, if it's an open mutual fund, you're not going to know what's in that other than 4 times a year. And then after that 4 times at the end of the quarter, they report that, they can move anything they want. One of the reasons why I like the exchange traded funds better, because at any point in time, I can see exactly what's in that fund. And more fund companies like ARK Invest on a daily basis will show you what they're buying or selling in that fund. And that's transparency. That's the truth of transparency. So know what it is, know what's in that fund, know what's not in that fund. One of the things which I'm seeing more and more is that these fund companies are putting out these funds and they name them, excuse me, case in point, clean air fund, a environmental fund, a social responsible fund. And then when I take a look at that, they've got some companies in there that have good returns, but they really aren't related to that fund group. So find out for sure what's in that. Then always do a correlation. That's one of the many things that is overlooked with investing. Find out what your company or fund, how it's correlated to the market. Is it correlated on a negative aspect or a positive aspect? That's part of what we call the DD, the due diligence we do before ever buying. And I'll just give you an example. We may be taking a look at a energy company. Well, let's see how it's correlated to the industry index, or let's see if it's correlated to the S&P 500, or let's see how it's correlated to the value of the United States dollar. So let's do that part of the homework after we take a look at where the big money is going and make sure that what we're buying is truly what it is we think that we have.
Now, there is, among the list, I see that you guys do at the Future is Now group, and I was wondering whether you guys are also taking into consideration climate change and any sectors which will benefit from this new push when it comes to addressing this whole entire issue of climate change? Is
well,
that
there's
something
ESG that actually has a lot of climate change priority companies in it, social governance. But climate change is definitely something that's a part of many corporations' strategy. And so, yes, climate change is a part of many of these companies that are in many of these funds that we're dealing with today. So there's a high correlation of climate change initiative and some of these funds and companies. Yes, sir.
So I've heard you talk about the space race and companies competing to go to space. And just curious, will there be, is looking for companies that contribute to making these space shuttles, looking for such companies, will it be a viable strategy to go around picking companies that, say, in communications and radar technology, on the S&P or the NASDAQ or any exchange? Will it be a viable strategy going to, in the future, to stock pick some of these companies?
Well, it depends on what our priorities are. If we're just investing in companies because they deal with climate change and that's what they focus on, or if we have a social cause, you got to be careful with that, because we're sensitive to those needs, and we definitely want to be. That's part of our strategy, and make sure that those needs are met with some of these companies. But I cautious investors. If you want to support these initiatives, then go ahead and donate to these initiatives that are doing this. Don't just put your hard-earned advertising dollars for your retirement into certain areas just because of the social causes. There's other ways we can support that, like I just discussed. So we want to make sure that every one of our dollars is like a soldier fighting for us to build financial wealth for our families that we'll have, whether or not it's at the trading week, the trading month, the trading year, or how we build this up for our retirement dollars. Okay, hope that answers your question.
Yeah, and now we'll take questions from the participants in today's webinar.
Not so many questions coming in, but Ian wants to know whether there is a minimum amount of shares one can purchase in the US market. I'm pretty sure he's asking maybe about micro lot size fractional shares.
Okay, I'm not 100% on the question, but let me answer it two different ways. We'll go back. If I take a look at a security, I want to make sure that it's trading at least 100,000 shares average a day, or the average over the 3-month time period. If there's something that's only trading 10, 20, 30,000, that tells me the institutions are not buying it. There's a reason for it. So I'll stay away from those for the most part. As far as fractional shares, 2 years ago, I said one of the largest things that's going to move this market and help the individual on Main Street, the individual trader and investor, are being able to buy fractional shares. And the fractional shares, some of the brokers are really embracing this, where there's zero commission. And very few people could go out and afford to buy one share of, let's say, Apple. But through the fractional shares, you can buy $50 to $100 worth of Apple at a time. You don't have to wait till you have the full amount to buy a $1,000, $2,000, $3,000 stock like some of these others are. So I think fractional shares, that's one of the biggest things that we can go in and study, and then find those brokers, online brokers, that have zero administrative fees, zero commissions. Now, you still got to have some expenses in those, but zero commissions, but be able to buy fractional shares, either by X amount of dollars, $100, $50 of it, or I'm going to buy a fraction part of the share. So that's the one single factor that's probably opened up this market for the investor and trader on Wall Street than anything else. And I'm so excited about fractional shares. If you think about it, we've had fractional shares for decades when you have brokers that will let you have dividend reinvestment. So we've had this in one aspect. Now we have it in a brand new aspect. And I'm going to make a prediction, and also fractional shares. How many people can actually go out and buy one whole cryptocurrency, Bitcoin, but through different online crypto brokers? Now you got to watch the fees on the crypto group, okay? So I could buy $100 of it at a time through this fractional. So that's the one key thing that everybody is listening to this and watching. Go in and find out about fractional shares. Does your broker offer those? If not, I'll throw two out to take a look at in the United States, Fidelity and Schwab. Some of the others have quasi fractional shares, which is really not fractional. But do your homework. And the fractional shares can open up so many opportunities for the trader and the investor on Main Street. And that's what gets me excited. Helping those on Main Street build financial wealth.
Okay. In Kenya, we don't have fractional shares. And a lot of us have what we call margin accounts. So a lot of people trade on leverage and the likes. And from your talk, it sounds like you are more of, you have a longer holding period with your trades. Do you think it's a viable strategy to use a margin account to do buy and holding over, say, 3-4 months, considering the costs?
Okay, one of the strategies that I teach is to focus most of your portfolio in your investment for longer term. From there, and let's just throw some numbers out, maybe 70%. Now, I know that all three of you sitting around that table, you guys have a lot of life ahead of you, and you're very young. And retirement seems like it's so far down the road you can't think about it. Well, newsflash, it's going to get here a lot quicker than what you think. Probably 80 to 90% of the people, 95%, they are underprepared for retirement in many ways. And by the way, in some cultures, retirement's not even a part of the vocabulary. With that being said, I always just stress for people to take a look at the longer term, 60-70% for your investment. If you like to trade, maybe 10 to 20%. And with that trading, you've got your longer term, your momentum, and your swing trading, only maybe 5% for your day trading. Because the higher, or the shorter the time period to hit your objectives, the higher the probability you're going to lose. And that's backed up by many statistics. So if you are going to be day trading, which, by the way, I'm not going to say don't day trade, because whenever I have the right situation, I love to day trade. So with that being said, if you're going to focus on day trading, stay the heck away from margin. Just stay the heck away from it, and you won't have to worry about it. Number one, with margin, there's high borrowing cost. Number two, and I'm not familiar with the tax structure in Kenya, but in the United States, depending on your income and your bracket, your short-term trades are taxed at a lot higher rate than your transactions that you hold a year or longer. So margin brings, yes, and back in the 80s and 90s, when I was a very active trader, and I used margin to the hilt. And one of the people that called me the most was the broker's margin person. Say, what in the world are you doing? I said, I'll be closing this out by the end of the week or the end of the day. But sometimes we learn what we don't want to, what we want to do by what we don't want to do. Stay away from margin. It only adds to the possibility of more downside than upside. All right. And also take a look at the futures. If you really want to extend your money, your futures, and I'm going to talk about that later or teach more about that later. But don't underestimate the power of options to really extend your buying power. And of course, in your retirement account, stay away from margin to begin with. And that's just experience talking. Right? Figure out what you can do with your money without having to borrow it. So make sure we aren't slave to the lender with usury. I'm sure you're familiar with usury in that term. And we don't need that, so just stay away. And the reason I say that is because I had so many students that didn't stay away, and they were financially wiped out, absolutely financially wiped out because they couldn't manage the risk. It's kind of like one of the things that whenever I was teaching at the college level, it's kind of like I was the emergency room doctor from the stock market. Not an actual physician, but people came to me after they made super bad trades and asked me, what do you do with it now? Or they were down 60, 70%. They were so far down, there's no way they could recover. They took on too much risk. They didn't know what they were getting into. You stay away. And by the way, the stock market's about managing your risk. There's always going to be risk involved. That's the difference that makes it less gambling. With gambling, if I go into the casino, I can't, and I'm playing that slot machine. In the old days, you used to pull the arms back. All right, maybe they still do that now. But there's no way halfway through I could stop the trade or stop the transaction. In trading, if I don't see it hitting my stock patterns, I can stop that trade. There's still that aspect of gambling and investing in trading, but what I teach it is that we look at from a managed risk standpoint. We have risk in everything. We must be able to work that risk, but don't let that risk work us. We're trading at margin and we're really extended out there, and with these leverage products, that risk is going to work us eventually. And unfortunately, many times, sooner than later.
Yeah, and David, you talked about the transaction costs that brokers charge and your recommendation for zero commissions and such. What would you say about the recent happening in the financial markets with Robinhood, and like what should people look out for, the red flags or the pointers when you want to trade with a certain broker, for example?
But one of the first red flags is to see how quick it takes for customer service to return your call. And if they do return your call, or they do send your answer, or if they don't send your 1099 forms out by when you're supposed to receive them. We're seeing many, many people of our Robinhood traders find that out the hard way. So how receptive a company is to your service. Here's another thing is if you can't get onto your online broker to place a trade, that tells you something also. But we must also be real about this. Whenever we're having a huge movement day in the market, it's going to be tough to get in touch with your broker. In an analogy of the visualization, picture a garden hose and picture a basketball trying to go through that garden hose. Well, that's how many people are trying to call their broker to get out of a trade or to place a trade, and the systems just can't keep up with it. So those are some of the things that I take a look at with a broker. I would never deal with a broker. Now, this also, I can't say never because I have dealt with some brokers that are privately owned, but I prefer brokers that I can also buy their stock. Why is that? Because if a broker is publicly traded, now I have more transparency about how strong that broker is or how weak that broker is. I also take a look, if I want a broker, case in point, I wouldn't go to a retail broker to trade futures. I want to go to a brokerage house that focuses on trading futures. If I'm trading options, I want to deal with a brokerage house that just focuses on options as their primary focus. Now, they may do stocks and ETFs as secondary, but I want to go to that broker that's going to be transparent. I can see how strong they are. I want my questions answered, and I want them answered in a timely fashion. And also no condescension. I can't stand it when people are condescending and they talk down to us. Oh man, is that a pet peeve of mine? So I want to be able to have a conversation just like we are right now. Just like we are in our backyard talking over the fence, neighbor to neighbor. And that's the way that it should be. So those are just some of the things to look at in taking a look at brokerage houses.
All right. So as we conclude, you can tell us more about the Simple Simon system and your garden growing, just for guys to have an understanding of what that means.
Simple Simon system. Well, first of all, I came up with the Simple Simon system while I was recovering from cancer. During that time, I wasn't teaching. I was fighting to live and continually pray for wisdom. And this type of information came to me during that time whenever I was recuperating. And what I was looking at is I taught many technical analysis, oscillators, indicators, moving averages. And I would teach people what they are. And I wanted to have some type of an equation. And it had to be simple. That the person could put that stock symbol into this equation, and it would give me a higher probability of an outcome. So guys, I studied hundreds, if not thousands, of different oscillator setups and combinations to find out what is the best setup of indicators that gave me a higher probability of profitability in trading. And I named it the Simple Simon, and it was 3 different things. If to go long, a stock has to be trading above the 30-period moving average, trading above that trend line, must have money coming into it, money flow. So those are the 3 things. If those 3 things weren't happening, that stock price didn't go up 80% of the time. And then you take that and just flip that around to the opposite side for your shorting or your put candidates. And that strategy is what I looked at whenever Jimmy Cramer came out with his 49 stocks he commanded people to buy right now. Well, first of all, I didn't care too much about him commanding people. But after I ran through his 49 stocks and saw that they were absolute garbage picks, that's whenever I did the Gentleman's Challenge to Jim Cramer. It was on CNBC. And by the way, 6 months and a year after that challenge, only 14, actually 13, but I'll give him 14, only 14 of those 49 stocks were positive and in the green. And so that proved that his picks that he commanded people to buy, they were garbage. So there's a couple of things to learn from that. And by the way, I gave everybody that emailed me, I gave them my Simple Simon system for free, just like I just discussed. So we don't go in and get our stock picks by an entertainer masquerading as a stock market expert. Now, I'm not putting down Mr. Cramer. You got to have some entertainment aspect to stay on TV as long as he has. And he has many good stock picks, but don't hang your portfolio just because he says it's time to buy. Go in and study the front running that's going on. Just Google front running, and Jimmy, you'll see so many things out there. But once again, he's a hardworking American. I watch him from time to time just to see what the movement of the market is, but do not make all your decisions by a so-called stock market expert. And I proved that to be true. Proof's in the pudding. There it is. And so what was the second part of that question, Sylvia? I'm sorry.
The garden growing system. Garden growing.
Oh, the garden growing, yes. It's one of my favorite systems. And I'll be doing more and more of that in the third and the fourth quarter of this year. What I do is I have, just like with the Futures Now group, 15 groups, I watch about 15 different groups of high dividend paying funds, closed-end funds, which those are some of the most overlooked aspects to invest in, and higher dividend paying exchange traded funds. Now, we don't buy a fund just because it has a high dividend. That can be very dangerous. But I go in and take a look at, from a proprietary standpoint, the stronger ones. And so then what I do is after pullbacks, and by the way, this is where I put my own money, I put X amount of dollars in high dividend paying funds. And then on a monthly basis, they buy me more shares. For the case in point, let's just say that I get into this garden growing and I buy, let's just say 100 shares of a group. Then I see how quick it can grow to 200 shares. Let the market buy me those extra 100 shares. So that's the garden growing. That's one of the most overlooked strategies that we have. But it's one of those things that people need to spend more time with it. And I'll be talking about it more in my columns later on in the year.
All right. Are there any questions from? All right. There are no questions from the participants. So you can tell us where people can go to find your work. You mentioned your website, eyeonthemarketsanalytics.com. Yes. And then do you still feature on the Backstory podcast? Do
I feature on what, Sylvia? I'm sorry.
There's a podcast that you used to feature known as Backstory.
I'm going to be doing more of that, especially as they are able to get back into the actually public office that I will have. That's where that was filmed. Up until now, it's been shut down. But in March, I get to move back into my public office. And that's where I do my mentoring one-on-one. Matter of fact, if people in Kenya want to take a look at mentoring, I'll be doing limited hours where actually we come in on Zoom and I help them learn how to really take a look at the market. So the mentoring aspect, and there'll be more information on that at my website, is going to happen. But yes, if they go to Eye on the Market, and it's spelled out EYE, not the I, letter I on the Market Analytics, you'll be able to find, and there'll be a link wherever we're going to be having this from a social media standpoint. There'll be a link to that. Just click on that and then go to sign up for the free, and it's free, the free columns. And then that's where you can find out more information. And also, if you want to, go ahead and get the special reports that'll be coming out March 15th. So that's where you go for more information.
All right, thank you for that. And then your book recommendations for investing in stocks and funds.
What was that last part? I'm sorry.
Do you have the book recommendations for people who want to start studying how to invest in stocks and funds? Book recommendations.
You know, one of the books, excuse me for just one moment. I thought I might have it that I could reach and get, but it's too far away. Jesse Livermore. There's a book about him, and I could give you a link on that, about the psychology of trading. And it was back in the early 1900s. The same psychology, because we're still human beings, and we still operate on emotion and greed and fear. That's one, The Anatomy of a Successful Stock Trader, I believe that's his, but Jesse Livermore, that's a must read. And there are many, many good books out there. Grab a book by Tony Turner, that's Toni Turner, one of the best authors that we have on different stock trading. To really further your skills as a day trader, there's a whole more books to stay away from than to go to, but Dr. Alexander Elder, excellent. So anything from Dr. Alexander Elder, Tony Turner, and then if you want to focus, the book that I introduced more of my students to when it comes to options. First of all, options can get very, very complicated really, really quick. But there's an author, Michael Sincere, and he also writes for Market Watch. His books break through the technology and the difficulty really quick. And he explains options in a way that it's just like we're talking right now. It's the same level. And I also like, there's two people that are on CNBC, John and Pete Najarian. And I've had the opportunity to work with both of those gentlemen. When they speak, I listen, especially when Guy Adami speaks. When they speak, I listen. And so now Adami's not written any books, but John Najarian, Jon, the Nigerian boys, I really, really like what they put out, especially on the options. That's a little bit more in depth. Michael Sincere's book is a little bit more for the starting out, but those are some that I would highly recommend.
All right. Thank you so much for your time.
Could I also add one thing?
All right.
I didn't mean, and I didn't mean to interrupt you. Dr. Alexander Elder. He also has a charting system called the Elder Impulse System that charts the things from a color aspect, red, blue, or green. We're visually oriented from birth. Now, we don't see color at birth. The cones and receptors in our eyes have to be developed a little bit before we start to see the color. But whether it's a stop sign, red, yellow, or green, many of the signals that we get were color oriented. Dr. Elder has taken a quasi version of like a candlestick, not a candlestick, but it kind of looks like one, and has adopted his color coding system to that. So if you can find the Elder Impulse System, you can find it through what I think is the best charting service out there at stockcharts.com. You can get the Elder, and by the way, I'm not associated with stock. I'm not a paid sponsor or anything. They just put the best product out there that I know to work with. And also, one of the reasons I liked it is they have a free version that I taught my students to use. That's very, very powerful. But on stockcharts.com, you can see the Elder Impulse System. And you'll see it a lot of times in my charts that I use. So if you're looking for something else to use that's easy to identify, then research the Elder Impulse System. And I think you'll be glad at what you find out.
All right, guys. So if you want to reach out to David, you can use his website, as he mentioned, eyeonthemarketsanalytics.com. He's also the only social media handle he has is on Facebook at David England, right?
Yes.
Yes. And we thank you so much for your time. And of course, we'd love to have you again in the future. And Scope Markets has US equities on their trading platform. So if you want to apply the lessons we've learned today, you can use their trading platform. So with that, we say goodbye until next time. Thank you.
Okay. Adios, amigos.
All right. Bye.
Thank you very much for the opportunity.
You're welcome.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.